Don Peebles is the chairman and CEO of the Peebles Corp, a privately held investment and development company with residential and commercial properties in most U.S. cities. Don, it's great to see you again. Welcome.
Thank you, Kelly.
Can you offer just a top-level word about what you think is going on with markets and the economy right now as you're here on a day when people are fretting quite a lot?
Well, look, I think that we've got a lot of worries about a recession coming in. Interest rates increasing has slowed the economy down significantly, and the concern is whether they go too far. What was encouraging yesterday was a 50 basis point increase as opposed to a 75 basis point increase. So I think we're slowing down, and I think the market will ultimately adjust in many sectors.
When you say adjust, how much more losses could we be facing in some of these commercial real estate sectors?
Well, I think that the commercial office space marketplace has been hit by a double whammy. High rates and a recessionary environment, but also a change in the way people work. Americans are working differently. Remote work is here to stay. Hybrid work is here to stay. And so there's a far less demand for office space. And that's putting a lot of pressure on REITs, for example, that have a large inventory of office space in markets like New York City and an older inventory because these markets are not created equally.
Yeah.
New office buildings are performing much better than older existing office buildings.
Let's say I'm in one of these funds. Maybe it's even gated now. Can they take my money and convert it into residential properties like we've seen in Lower Manhattan, for instance? This was already happening over the past 10 years. Empty office space was becoming fancy new, apartment space. And is that going to just happen across the country? And could that bail out investors here?
Well, I think it can help in New York, but I think that what happens is a value hit from a commercial office building that was performing properly prior to the pandemic. The valuations now are down 30–40% and will go down further. And the exit is a conversion to office space for many of these buildings. And I think New York City and Washington, D.C., to a lesser degree, will be helped by that. Those are the two hardest hit markets in the country, is New York City and Washington, D.C.
What's going to happen if some of these funds do end up having to sell assets at, distressed or even fire sale prices? It feels like that could still be another shoe to drop here.
Yes, it is. And I think that there'll be losses. I mean, any fund or any REIT that's heavily concentrated in commercial office space in the major U.S. markets, excluding, say, Texas and Florida, I think are in for a very rude awakening. So there are going to be significant losses. The cost to convert these buildings to apartment use, which will produce ultimately less income than those office buildings produced pre-pandemic. So I think you're going to see a lot of losses there.
Wow. So what's your advice to investors? Where's the opportunity? What should people do right now? Or is it all predicated on the Fed eventually pausing its rate hikes?
Well, I think pausing the rate hikes would be helpful, but it won't bail out commercial office space. I think you've got to look at the more entrepreneurial funds that are able to pivot. So you have larger funds that, the Blackstone funds, the BlackRock funds, some of the Goldman funds. Those funds tend to be much more entrepreneurial and nimble, and they have other places to go. So they have other strategies. And I think that, taking these commercial office buildings and converting them, especially those who are now buying. So anyone buying commercial office buildings to make the conversion now, those are going to perform well. And so there's some new funds that have come out that are opportunistic. There's some new ones that have come out to raise money to buy and convert commercial office space in New York City and Washington, D.C. and San Francisco. Elsewhere, I think those will perform well.
Yeah, it makes a big difference when you're starting with a much lower purchase price. Final question. I'm a little surprised that a company like WeWork wouldn't see better fortunes right now because the traditional work environment has broken down, but people do still have this desire, this need to kind of have a place to do their business. Do you think that model will emerge better from this over time, or is it simply just challenged because there's just fewer people in that pool than there might have been a couple of years ago?
Well, I mean, WeWork is not a new innovation anyway. I mean, we just had been doing this for quite a while, many decades. And so what's happened is WeWork was focused more on the startups and the entrepreneurs. And that's not where the opportunity is in flex commercial office space. It's for the small, mid-sized, and larger companies that want to remain flexible now. And I think also what's going to happen is commercial landlords are going to have to change about how they lease their office space. It'll be more short-term. You'll see more commercial office building owners actually get into the same kind of business that WeWork is in with flex space. And so that's going to put a lot of pressure on WeWork's ability to produce better earnings.
Yeah, and if you want exposure to, kind of that third place where people might show up and just casually work, you just buy shares of Starbucks, and you don't need to worry about the fundamentals in real estate at all. Don, thanks very much. It's good to see you today. We'll check back in soon.
Thank you, Kelly.
Don Peebles with the Peebles Corp.